All righty. Hey, everybody. All right. Um, welcome to Investing. Ask Paul. I like to think of investing like planting a tree. The dollars you earn from your job are seeds, which you can choose to eat or plant. And if you plant them, they will turn into a fruit-bearing tree later. My goal here is to teach you how to plant those seeds. Warren Buffett has a famous quote: "If you don't find a way to make money while you sleep, you will work until you die." You'll never get rich working a job, but your job is your number one wealth building tool. And living on less than you make and investing the difference is how most wealthy people got to where they are. Getting ahead in life and building wealth is a function of what you do with your limited resources. You can make $2,000 a month or 2 million, but if you spend it all, it doesn't matter. Some people think that they'll start saving or investing once they make more money, but that's just an excuse. We are all limited by our income, and there is no salary in the world that you can't spend. You might think that that 2 million example is extreme, but Johnny Depp was facing bankruptcy a couple of years ago because he was spending $2 million a month. So there is no salary in the world you can't spend. We need to find ways of saving part of our income. Make money work for you instead of the other way around. It's important to invest and start as early as you can to allow the returns to compound. So saving part of your income is a good first step, but cash in the bank loses value. You've probably noticed prices have gone up recently, right? Inflation, right? You're not the only one. The Federal Reserve has basically doubled the money supply in the past couple of years, so naturally more money chasing the same amount of goods and services will drive those prices up. Add to that the supply chain issues we've been facing during the pandemic, and you have an environment ripe for inflation. So how do you hedge against inflation? By owning assets. That's what investing is, owning assets. Stocks, bonds, real estate, precious metals, even crypto, though the value of that last one really remains to be seen. Last I checked, inflation is about 7% or so, and the highest yield savings accounts pay maybe 0.5%. So you're losing like 6.5% a year by holding your money in cash. Now, that's not to say that cash doesn't have its place in a wise investor's portfolio, but if you want to keep up with inflation or even beat it, you have to put your money in other things. I will talk about those things, but first I want to teach you a few concepts. So here's some investing advice. There is no get rich quick in investing. I'll say that again. There is no get rich quick. Risk and reward go hand in hand. If you want a high return, you're going to have to take some outsized risks, and that means you can potentially lose all your money. People who make a ton of money in a very short period of time are taking very high risks. It may have worked out for them, but it might not work out for you. So avoid things that seem too good to be true. What's that mean? Well, the US stock market tends to return about 8% a year, and stocks are fairly risky. So if someone promises that they can double your money, so that's 100% return, right? In like a week, that's a 5,200% return a year, which is way higher than the stock market's 8 to 10%, and also way riskier. It's too good to be true. It's probably not true. As you start becoming wealthier, people will come out of the woodwork to try to relieve you of some of your money, but they won't ask you for it, no. They'll come at you with a, quote, business opportunity. And it's probably a better opportunity to say no. Chances are, if they're asking you for money, they already asked the bank, and the bank turned them down, probably because it was a stupid business idea. Avoid buddies with a business idea. So there is a powerful quote in personal finance: time in the market beats timing the market. The stock market is very volatile. It goes up, down, and sideways. Sometimes it crashes pretty hard. Last year in February and March, the stock market dropped by over 30%, but has since doubled from its March lows. So patience is your friend. Some people might try to buy low and sell high. They'll try to predict what the market will do. They'll try to sell before a crash, all that stuff. But people suck at this. Active traders tend to underperform passive investors. And passive investors are ones who just buy and hold, right? Your best bet to make money in the market is to invest as early and as often as you can. Avoid trying to time the market, basically, oh, I'll buy when it crashes. It's too expensive right now, wait, and to let time and compound interest do its thing. Very important, never ever gamble money you can't afford to lose. Don't put all your money in one thing. Don't put your life savings into something super risky like cryptocurrencies. I own some crypto. Actually, it's turned into quite a bit, but I only put a couple thousand into it, a very small amount. Something I was comfortable losing, something that wouldn't be very detrimental if it went to zero. And when it comes to speculative investments like crypto and some other stuff, be okay losing 100% of your investment. Keep it simple. Keep your investing strategy simple. Warren Buffett was on CNBC a few years ago, and he said, if you don't invest in things you know, you're just gambling. It's advice he's rarely strayed from, and it's the reason why tech, gold, and airlines will never get his money. Or actually, airlines, he did invest in airlines, but never again. So it's never going to get his money again. And as he wrote in his 2014 shareholders letter, you don't need to be an expert in order to achieve satisfactory investment returns. But if you aren't, you must recognize your limitations and follow a course certain to work reasonably well. Keep things simple, don't swing for the fences. When promised quick profits, respond with a quick no. Before you start investing, make sure you understand your finances. Understand where your expenses are going, see how much money you need and how much of your paycheck you can reasonably afford to put away, either into savings, debt repayment, or investing. And try to put that away every single month. Second, get out of debt before you start investing. It does no one any good to earn 8% a year in the stock market while still paying 20% on your credit cards. That's a negative 12% interest rate, right? Investing while still in debt is trying to fill a bucket with a hole. If your interest is low, the one caveat there is if your interest is low, say like a 3% mortgage or a 4% student loan, it's okay to invest and pay off your debt at the same time. But as a general rule, you want to be out of debt first before you invest. Third, have an emergency fund. That's 3 to 6 months worth of expenses in cash in a savings account or something else that's very liquid that you can access. So for example, I have my emergency fund in a USD coin, which is tethered 1-to-1 to the dollar, and it pays me 10%. But it doesn't fluctuate. So it is fairly risky because it's not FDIC insured, but I've had it for 2 years and it's worked for me. But for most people, an emergency fund has to be in cash in a savings account. And you're not going to get, you'll be losing value to inflation, but the purpose of this thing is to be there for you, right? The liquidity, the ability to access it at any time. Fourth, understand what you're getting into. If a buddy told you he made lots of money in real estate, but you aren't comfortable with that asset class, don't get into it. You know, same goes for stocks, crypto, whatever. That's not to say you can't learn. You really should educate yourself before you jump into anything. Personally, I really like stocks because they're so passive. I don't have to run the companies I own, you know, that you have the board of directors for that. I don't have to screen tenants and fix broken faucets. It's passive. I can live my life, do what I want while my investments make money for me, but without spending any of my time managing them. If you saved $500 a month, like just put, you know, cash aside, it would take 2,000 months to reach $1 million, which is 167 years, which is probably beyond any of our lifespans, right? However, if you invested that $500 a month at 8%, which we know is what the stock market has historically yielded, you'd be able to reach $1 million in just 33 years. Investing the money speeds up the timeline due to the exponential power of compounding. And compounding happens, I'm sure everybody knows what that is, but compounding happens when interest grows on previous interest. It starts really slow, as you can kind of see in this curve, right? You know, for the first 15 years, you barely made any money. Actually, it doubled after 15 years, but after a while, it grows exponentially. Remember, time in the market is your best friend, and that's why it's so important to start investing as early as you possibly can. Someone who invests $5,000 a year starting at age 25 would have $1.4 million at age 65, which is pretty good. But someone who started just 5 years earlier would have almost 2.1 million. That's almost $700,000 more than the person who started just 5 years later. The most impactful investing dollars are those invested the earliest because they have more time to compound and to grow. So what I want you to take out of this is that you should start saving and investing as early in life as you possibly can. Do it now. Start now. Start yesterday. After we get done with this, open a Roth IRA. You know, start investing. Did you know if you manage to have $100,000 in the stock market by age 35, you could retire with $1 million at 65 without adding a penny more? This is because of something called the Rule of 72, which is a quick mental calculation you can use to estimate how long it will take for an amount to double. You basically divide 72 by the interest rate to get the number of years. The stock market has historically returned 8%. So if you had $100,000 invested, it would take about 9 years. So 72 divided by 8% is 9 years. It would take 9 years for that $100,000 to double to $200,000. Another 9 years would yield 400,000, and the third 9 years would get 800,000, and so on. And so it would take about 30 years, between 35 and 65, to get to $1 million. Now, the rule of 72 works for investing as well as debts. A credit card charging you 24% will take 3 years, right? So 72 divided by 24 is 3. Will just take 3 years for the credit card balance to double. And that is one of the reasons why it's so important for you to get out of high interest debt as soon as possible. The higher the interest rate, the faster the money compounds. So like a 3% return would double your money in 24 years, right? 72 divided by 3. A 6% return would double your money twice as fast. And with a 12% return, you double your money in how long?
6 years.
6 years, that's right. 72 divided by 12 is 6 years. Anyway, so let's do some math here. We already talked about credit card interest, right? If it's at 24%, 72 divided by 24, it takes 3 years for the balance to double. If you have money in a savings account and they're paying you 1%, how long would it take for that money to double?
72 years.
72 years, right? If you have bonds and they're paying you 6%, how long would it take that the money you put in bonds to double?
12.
12 years, right? And let's assume you have a speculative investment, 18%. Remember, anything that's higher return will also give you higher risk. So a speculative investment might give you 18%. How long would it take for an 18% investment to double?
Take 4 years unless it crashed.
Right. Well, we're going to assume it gets 18% guaranteed. You know, this is just an assumption, right? So
Yeah, give me the name of that one.
I couldn't tell you. Nothing I can recommend. But yeah, so the shorter the time it takes the amount to double, the more doubling periods you can squeeze into your timeline, and the faster compounding will work. So take a look at this. You have three investors, one that gets a 3% return, 6%, and 12%. At 3%, it takes them 24 years for the 10,000 to double into 20. If you have 12, it takes only 6 years. So you get to double that thing more and more often. So you have somebody getting 3% after 48 years, they only have 40,000, but at 12%, they have 2.5 million, right? So now I'd like to talk about the different asset classes. Remember, the higher the return, the higher the risk. The only really low risk or quote risk-free assets are cash, precious metals, or treasury bonds. Stocks are my personal favorite because they have been shown to be one of the greatest wealth creators over time. They tend to get 7 to 10%, which is after inflation, about 6 to 7% real growth, but they can fluctuate wildly day to day or year to year. Really, if you don't have more than like 7 to 10 years to invest, I would not put that money in stocks. So if you're planning on buying a house in 3 years, don't invest that money. That money needs to sit in cash or something a little safer, some treasury bonds or something. Next, we have bonds. They tend to be somewhat safer. They don't fluctuate as much, but you're also getting a lower return. Bonds are useful in investing for retirees because they produce a steady stream of income, and for other investors because they tend to be negatively correlated to stocks. And what that means is that when stocks go down, bonds tend to go up. So they kind of smooth out the ride, smooth out the investing ride, and your stuff doesn't crash as hard, right? They also limit your returns. So then there's cash, which is really only useful for something short term, like an emergency fund, or if you're looking to buy an investment soon, or like a property or something. Then there's gold, which is a good hedge against inflation, meaning it keeps its purchasing power, but it doesn't really grow in value. And some other asset classes I won't go into in this presentation. Real estate can also be a good idea, but I don't invest in it, so I'm not really the right person to talk about it. Key takeaway here: if you have a long timeline, don't be afraid of risk, of volatility, of the asset prices going up and down. So young people really should invest mostly in stocks, and older folks should invest in stocks, bonds, and maybe gold. Speaking of which, gold has been a store of value and a hedge against inflation forever. And so gold has been a store of value forever, and it probably continue to be, forever. But it doesn't really grow in value, it just maintains it. It's what Warren Buffett likes to call a dead asset. It's useful in that you can generally buy the same amount of stuff with a piece of gold at any point in history. So for example, in 1960, gas cost about a quarter, 25 cents a gallon. Between 1939 and 1965, or was it 32? Anyway, before 1965, quarters and dimes, and I believe nickels too, but quarters were made of 90% silver, about 0.18 troy ounces. If you melted, today's silver costs about $23 to $25 in a troy ounce. So if you melted down a pre-1965 quarter, you'd be able to sell the silver for about $4.50, which you may notice is enough to buy a gallon of gas. So a silver quarter back then would buy a gallon of gas 60 years ago, and it will buy that same gallon of gas today. So do you see what I mean about precious metals kind of retaining their value but not growing? Precious metals are great at retaining their value. They don't grow. For that, we need to look at other asset classes. Short-term investments, like I said, cash, bonds, gold, they're pretty much the only things that are good for the short term, right? If you know for sure you will need some money within 5 years, you do not invest it in stocks or other high return and high risk ventures. Some things you might consider in order of risk: savings accounts, CDs, treasury inflation protected securities, a money market account, short-term bonds, city bonds, and company bonds, corporate bonds, right? So those are some short-term investments you might consider if you have purchasing these within the next 5 years or so. This is a chart showing between 1975 and 2017 how different asset classes performed. Notice at the bottom there's the CPI, the Consumer Price Index. That's inflation. And notice how gold, the red line, basically keeps up with inflation, right? That kind of goes to what I was talking. Then you have bonds. It has a little better return than inflation, but not much. And then you have stocks and real estate, which kind of like way outpace it, but you can also see how risky it is, right? So it can crash really hard. And notice how real estate has a slightly, REITs, they're real estate investment trusts, that it has a slightly higher return, but it also has, higher risk. And here's another thing. If you invested $1 200 years ago in stocks, today you'd have over $1 million. If you did it in bonds, you'd have 1,500. Bills, which are shorter term bonds that the Treasury issues, about $300. Gold would have grown slightly, but not by much. And then the dollar would be worth, 1/20th of its value 200 years ago. Now, you can invest in single stocks, which I don't recommend, or you can invest in mutual funds, which are a package deal of stocks, kind of like a bunch of stocks, a bunch of different companies in one investment. With mutual funds, you have to be very careful of the expense ratios. Most actively managed mutual funds will charge you a fee anywhere from 0.5% to 2%. Most are around, like 0.75%, 1%. And then on top of that, the portfolio manager will charge you another 1% fee to invest for you. So you're out maybe 2% a year, whether you made money or not. And if you're thinking, oh, it's only 2% and I'm making 8 or 10 or 12% a year, it doesn't really matter, you'd be wrong. Let's assume your investments made 12% and your money manager charged you 2%. And let's go back to the example of the person who invested $100,000 and left it alone for 30 years. At the end of that period, you'd have over $1 million less than if you didn't have that 2% drag, right? $1.2 million less, just with a 2% fee, right? So even small reductions in your annual returns can reduce your final balance by massive amounts. So this is one reason I always invest in funds with low expense ratios. High fund fees can decimate your returns, and this is why I like low-cost index funds, such as Vanguard's Total Market Index Fund, which has an expense ratio of just 0.04%. Compare that to a more actively managed mutual fund, which is, like I said, 1 to 2% of your account balance every year, even if you lost money. Now, here's more bad news for managed funds. For the last 20 years, 86% of active fund managers underperformed just the general stock market. That means that their investors would have been better off investing in a boring S&P 500 or total market index fund. And passive funds like index funds, they track a basket of companies, like a list of companies. And while they may be less glamorous, they are also a lot cheaper. So you've heard, keep this in mind, I've already talked about risk and reward, but you've heard of people investing $40 and making $10,000 in a short period of time. Well, chances are that success they had is not repeatable. They probably took some insane risks to make that money. When we talk about risk in investing, it means the likelihood that you'll lose money. If you, Mr. or Mrs. Investor, put your money into some cryptocurrency or one of the companies during like the dot-com bubble, there's a chance it could blow up. And there's a chance it can drop sharply or even go to zero. That is risk, right? The return you get from an investment is payback from the risk for the risk you're taking. If your rich friend asks you to loan him $500, you probably won't charge them a lot of interest or none at all because you know they're good for it. You know they'll pay you back, right? However, if your deadbeat friend borrows the same amount, you don't know if he's going to pay you back. So you're probably going to want some collateral or a much higher interest rate to justify the increased risk you're taking. Same thing in investing. The higher the risk the investor takes on, the greater the rate of return, the reward has to be to justify them putting their money in this thing. When the government borrows money, the interest rate they have to pay is going to be very low because the loan is not very risky. You know they'll be around for a while, and as long as they have the power to tax their citizens, the loan will get paid. If you invest in a safe business or one that has been around for a while, you won't get as high a return as if you were to invest in a startup, something that hasn't been proven yet. But if you do, there's always a chance you can multiply your money a lot faster than if you played it safe. So the stock market has returned 8 to 10%, but year-to-year returns can fluctuate wildly. Some years you're up 30%, some years you're down 10%. It's very risky. There have been periods when you're down for 10 years or more. So when it comes to investing in the stock market, you have to have a long-term mindset and time frame. The S&P 500, which is often used as a proxy for the stock market as a whole, has been positive on a little over half of all days it was open. So if you choose to invest for a single day, you'd have about a 54% chance of making money, about half and half. But if you left your money in for a whole year, your chances rise to about 3 out of 4. So 3 out of 4 years you'd make money, and about a quarter of the time you'd end the year with less than you started. And as you continue zooming out, notice how the likelihood of you having a positive return increases. 86% of all 5-year periods have been positive, 94% of 10-year periods. And there isn't a single 15-year period in stock market history where a buy and hold investor didn't end that period positive, right? So it's important to invest for the long term if you're going with stocks. And that means if the market dips, you don't sell it. And if the market's crashing and you're getting worried, when in doubt, zoom out. If you're ever worried about the market going down, just zoom out and look at what it's been doing, right?
Okay, so what does that mean, that when in doubt, zoom out? I mean,
Okay.
don't pay attention, ignore it.
Exactly. But yeah, when in doubt, zoom out. So like day to day, the stock market can look like this, right? But over the years, some years it might go down, but there's a long-term upward trend. And over the decades, it goes up into the right exponentially, right? You just have to allow your money to grow and not worry about what it's doing day to day. Just know that the economy will generally always grow and asset prices will along with it, right? Okay, so time in the market, right? Time in the market beats timing the market. A little more on this. The best advice to regular investors is put your money in and check back in 20 years. Invest as early and as often as you can and ignore what the market's doing. Most importantly, don't sell after the market has dropped. That's the worst time to sell. Most investors are emotional. So the more the market drops, the more people are tempted to sell and try to salvage what little money remains. But this is a great way to lock in losses. Remember, you don't lose money until you sell. Now you might think, well, I'll just pull my money out before a crash and put it back in at the bottom and I'll get higher returns. You're right, but Millions of people have tried that unsuccessfully. The problem is that no one knows what the market will do tomorrow, let alone next year. Between 2003 and 2013, the market averaged 7.5%, but the average investor, you'd think, the average investor, someone trying to trade in and out of the market, trying to pick stocks, they got an average return of just 2.6%. Someone who put their money in an index fund that tracked the S&P 500 would have earned an average of 7.4% over that time period, but instead the average investor got 2.6. So the big concept here is not to try to outsmart the market, because you probably won't. Your best bet is to invest in index funds, dollar cost average, meaning you put money in every paycheck, and never sell, no matter what the market is doing, until, of course, you hit retirement, right? So Fidelity conducted a different study where they looked at the types of investors that had the highest returns. Number one, accounts belonging to dead people. Number two, inactive investors, people who switched jobs and had forgotten about their 401ks. So what this means is that the best returns were achieved by people who did nothing. They didn't trade, they didn't try to outsmart the market. Nobody knows where the market will be in a year or in 5 years, but we can assume with relative certainty, based on historical performance, that it will be higher than it currently is in 10 to 15 years. Now let's talk about index funds. By now you're probably asking me what you should invest in. And the short answer is index funds. And again, I'm not a financial advisor, so don't sue me if you make bad investment decisions, but this is just general advice, my recommendation, right? An index is a list of stocks, and the most famous are probably the Dow Jones or the S&P 500, and they track a group of stocks. So the S&P 500 contains the 500 largest and strongest companies in America, and here you can kind of see the breakdown, and notice how 5 companies make up half the index, right? So when you buy an index fund, when you buy an S&P 500 index fund, half of that is just going to be these 5 companies. And I believe this is from 2020, so I believe Tesla recently got added to that. So yeah, when you buy an S&P 500 index fund, you're getting a small piece of all 500 companies in just one investment. It's very simple. Remember what Warren Buffett says, keep it simple, right? Be diversified, keep it simple. Another great aspect of index funds is that they have very low fees. They're not actively managed, so they don't cost much in terms of research or analysis. All they do is buy all 500 stocks on the list, and whenever a stock drops out of the index fund for being a crappy company, another stock will replace it. So the index is kind of self-cleansing, so you never really have to worry about it. Keep your investing simple. This is a list of index funds you can buy in each of these companies. Now, Vanguard, Fidelity, Charles Schwab, they're all fine. I have my retirement accounts through Vanguard. My wife has it through Fidelity. They're all good. I prefer Vanguard because it's kind of owned by the investors instead of a publicly traded company. I'd like to talk about tax treatment, taxes on investment income. You may have heard that the wealthy pay less taxes than regular folk, and that's partly true. That's because unearned income, investment income, which is where most rich people's income comes from, is taxed at a lower rate than money you had to work for. If all of your income came from investments, as it probably will be when you retire, you could make over $100,000 as a married couple and pay 0 in federal taxes. So this chart over here on the left is the long-term capital gains tax rates. So in 2021, this year, the standard deduction for a married couple is about $25,000. So that means that the first $25,000 of your income as a married couple isn't even taxed, right? And then you can add on to that up to the $80,800, that's the upper limit of the 0% tax bracket. And really, if you had no other income, you can take $106,000 of profits when you sell your stocks that you've held for over a year, or some other investment, and not pay anything to the federal government. Now, state taxes are different. California taxes investment income just like regular income. So yeah, and if you're a real estate investor, you can defer taxes indefinitely by just rolling the profits from the sale of a house into another house by means of a 1031 exchange. And again, this only works for long-term capital gains. If you held on to the investment for over a year before selling. If it's less than a year, that's short-term capital gains, and you'd be charged the regular earned income tax rate. And the government does this to incentivize investing. So you're going to pay less on investment income than on earned income. But there's an even better way to reduce or avoid taxes, and that's by investing through tax-free retirement accounts. And you really should contribute to these accounts before you buy stocks through like a regular taxable brokerage. So most of us have heard of a 401k, or we have one. Depending on who you work for, it can be called a thrift savings plan, TSP, or if you work for like a nonprofit, it could be a 403b. But all you really need to know that this is a retirement account you get through your job. For 2021, you can contribute a maximum of $19,500, or if you're over 50 years old, $26,000. That's what's called the catch-up contribution, this extra $6,500, right? Then there's the individual retirement account, which you can open through a brokerage company like Vanguard or Fidelity. And just to be clear, these are not investments. They are accounts where you invest through these accounts. You hold your investments. They're like a wrapper, like a tax-deferred wrapper. For most people, I'd recommend a Roth IRA and a Roth 401k or TSP. Grows tax-free, and in retirement, it's completely 100% tax-free. But I'm willing to pay the guaranteed low rate instead of getting the tax reduction now and paying whatever the government decides to charge me when I retire. So that's why I like the Roth account. For people who make a whole bunch of money, traditional may be better because it reduces your taxable income now. You can do stuff with it, and then in retirement, you'll have to pay taxes, but you'll find a way to reduce those taxes at that time. An HSA, a health savings account, is the #1 best investment account out there. It's only to be used for health expenses, but this is America, so we will always have health expenses. So an HSA is triple tax advantaged. Look into it if you qualify. And then here we have a brokerage, just like a regular taxable brokerage like E-Trade, Robinhood, or something you can get on Vanguard or Fidelity. And it's taxed 3 times. Once when you put the money in, every year the dividends and interest get charged, or if you sell something. And then when you withdraw it in retirement, it's going to be taxed as well on the profit. So you always want to invest in your tax-free accounts before you do that, right? I have both my IRA and 401k as the Roth version. And if you don't have a Roth IRA yet, I would highly encourage you to open one today. This is Peter Thiel. He was one of the founders of PayPal. And in 1999, before the company went public, he put $1,700 worth of PayPal stock into his Roth IRA. Since then, the company has gone public and the stock has increased in value. And his investment inside the Roth IRA has increased to over $5 billion. But since it was invested within the Roth IRA, he won't have to pay a penny in taxes. Here's another example of why you should invest through retirement accounts first before your taxable brokerage. Now, this is my Roth IRA. I contributed a total of about $62,000 over the years. You know, from a very early age, I understood the importance of investing and the value of paying taxes once and not being on the hook to the government ever again. I opened it when I was 24 and I invested the max almost every year. Today, that $62,000 that I invested over the years is worth about $160,000. And I always invested in index funds and I ignored the fluctuations. And yeah, if it continues growing at 60, that if I stop contributing at 60, my investments my Roth IRA will be worth about $1.5 million. At 65, it'll be worth 2.2 million. And then if I let it grow till 90, it'll be worth about 12 million. And that's without contributing anything else. But of course I will continue contributing, so it'll be a lot higher by then. And this is my income, just to show you that, you know, I built a $1 million portfolio on a normal person's income, you know, and I live in California too. It's expensive here, you know. I never made 6 figures. In fact, the average was about $60,000 over the past 11 years, but I was frugal and I saved as much as I could. I always prioritized saving. Didn't matter how much I made. You know, in 2015, I made less than $20,000, but I still managed to save $800 that year and invest it. And today at 37, I have about 1.3 million. And notice here this inflection point, right? At the beginning of 2020, it about doubled from 500 to 1 million. And that's because I had some side investments in Bitcoin and Tesla that kind of blew up. So I couldn't have foreseen this, and I'm happy it happened, but I wasn't expecting it. You know, this was all my index funds, and this is what I think most people should focus on, not the lottery tickets, not the speculative stuff, not the gambles. General investing advice: diversify. You know, don't put all your eggs in one basket. Don't put all your money into like one thing, one company. You know, don't gamble money you can't afford to lose. I put some money into crypto knowing it could crash and burn, but I was okay with that risk. I treated it like a lottery ticket. Index funds. Invest in index funds. You get your diversification plus passive investing beats active investing 99% of the time. You may be that 1% that can beat the stock market, but chances are that's not you, you know. Stay away from fees. The expense ratio, they did studies and it showed that the expense ratio, the cost of that fund, the management fee, is the #1 performance indicator. Most financial advisors say 100 to 120 minus your age in the percent should be in stocks, remainder in bonds. So if you're 70 years old, 120 minus 70 should be in stocks, so about 50%, the rest in bonds or something else. Personally, I think you should never really go below about 60% stocks, because they even when you're retired, you still have decades of life ahead of you. So you want that investment to grow. But you know, I'm not a financial advisor, so don't do your own research. You know, don't take my stuff as ironclad. Educate yourself. Keep in mind that there is no safe get rich quick method, and people will lie to get your money. So most importantly, habits are greater than knowledge. Consistently investing is what will make you rich. You know, it doesn't matter how much knowledge, how much investing knowledge you have. If you don't invest, nothing's going to happen, right? So save your money. Every paycheck, set some aside towards your investments. And once again, invest in your tax-free retirement accounts before you invest in anything that's not in your 401k, your Roth IRA. If you haven't maxed out your 401k, if you haven't maxed out your Roth IRA or your traditional IRA, you have no business investing in cryptocurrencies or in single stocks outside of those retirement accounts. Really, you don't need someone to manage your money. You can do it yourself. Just read some books, you know. Wall Street makes it complicated, but don't pay attention to all that noise. You know, just invest in index funds and have patience. All fees add up to hundreds of thousands over time. So avoid high expense ratios, you know. Diversify, don't put all your eggs in one basket. Put your money in different companies, different asset classes. I have mostly stocks. I have single stocks. I have crypto. I have a little bit of bonds. I have a little bit of real estate through a REIT, real estate investment trust. And don't put all your money in GE, in Enron, in Bitcoin, because it can crash. Enron doesn't exist anymore. And there were people who had their entire life savings in it because it was going up like crazy for a few years. And that's why people got excited and put all their money into it, and now it's gone. If you would like to learn more, I recommend reading these books. The #1 book I recommend everyone read is The Simple Path to Wealth. Most of my investing philosophy centers around this. If you're in debt, Dave Ramsey's Total Money Makeover is a good book. And also, I would like to welcome or invite you guys to join my Facebook group, Financial Stuff. Look for it on Facebook. And I have a blog, dollarbills.com. So I have a bunch of stuff on there, you know, a bunch of articles I've written. I have resources, links to my YouTube channel. I have investment calculators and all that stuff. I'd like to leave you with this. The best time to plant a tree is 20 years ago, and the second best time is now. So don't feel bad about if you haven't started yet, or if you didn't start 20 years ago. Start now. You know, in 20 years, you'll be happy you did. When I said do not invest in anything outside of a retirement account, I was referring more to people who have dollar signs in their eyes and they're going for the speculative stuff like crypto. I'm trying to encourage people to be grounded and think smart, you know, think long term and not try to get rich quick.
You brought up a really good point, which is that oftentimes, you know, people on Wall Street tend to make these things very complicated. A lot of investment advisors, you know, are literally just money managers, and they will manage your investments for you, which I agree is pretty easy to do on your own. You know, you can read The Simple Path to Wealth and it'll tell you everything you need to know. But I think that there are reasons for some people to meet periodically with a financial advisor, and that might not be them managing their money. That might just be them paying a few $100s a year to meet with them and say, you know, evaluate major life decisions. Like if you are planning on taking Social Security, there are a lot of rules surrounding that a financial advisor who, you know, specializes in that can be really, really helpful. And it might be worth paying the, $400 a year or whatever it costs to sit down and meet with them. There are a ton of financial advisors out there that are, fee only, and they don't have to manage your assets, because I agree, it's pretty simple to do it on your own.
And my boss, Ray Martin, has been in the industry for close to 30 years, very principled. He manages the little money that I have. I'm also employed by him because I sell Medicare insurance, but he will do consulting and he'll also manage, but he's not going to oversell managing your accounts in lieu of giving you simple financial advice. He's happy to do that.